How's it going, everyone? Lawrence here from Financial Thing. It's a Thursday evening vlogcast, video vodcast, live stream. I never did figure out what to call it. Hope you're having a really wonderful week. Let me move my seat up a little bit. Hold on. Oh, see? Live. You'll see an empty bed in the back. We should have our special guest appearing at some point. There she is. We got some really interesting things to talk about this week. We'll do a little bit of peer-to-peer lending news, and we're going to be, of course, talking about Assetz Capital and their freeze on their access accounts, which it was kind of unexpected to get an email like that, but when I started to really think about it, it really made a lot of sense to me. So we'll have a chat about that, and I'm going to go through my account and kind of show you why I thought that it made a lot of sense that this was a good possibility of this actually occurring, even though, of course, it's not what we want to see. And we are going to talk about what can we learn also in peer-to-peer lending and investing that will come from experience of what we've seen in some of the cryptocurrency fallouts, particularly FTX, one of the biggest, you could call it scandals. I don't know if scam is the right word because we don't really know yet, but certainly very disappointing, and that is going to make Bernie Madoff look like a small fish compared to what this guy has done. So several $billion into a company now that is in bankruptcy. So what can we learn in peer-to-peer lending? Because we have been through this before, certainly not on as big a scale, because obviously cryptocurrency is a lot bigger, or was at the time a lot bigger than certainly peer-to-peer, but we can definitely learn some things from the FTX situation, from the Celsius situation that has left a lot of people scarred in the crypto world. So we're going to talk about that. We'll take a look at the Trading 212 portfolio. We've had a bit of a bashing in the proverbial ghoulies this week, so that portfolio is definitely struggling a little bit this week. But I'll show you what's going on with that too, and we'll have a chit-chat about some other things that are out there in the news. Hope you are having a great week. Please hit that thumbs up if you can. It really does help out. It takes just a second to do. Well, let's have a quick hi to everybody in the stream. Wait, where's my... Hold on. Let's turn on the comments. There we go. Dave Dawson, Double D is here. Dividend Dave. Hi all, first for once. Yes, usually sort of a later addition. Stephen Hale in Nottingham. Mike Powell is here from Southampton or wherever else he is roaming around on planet Earth. Colin Perry in the Peak District. Paul is in Kenilworth, of course. Alan Stratford in, I forget where. Peter in Leatherhead. Misty, moisty start to the day. Moisty. Steve E is here. Welcome, Steve. Glad to see you. John Day in Nottingham. Annabelle Nyron from Spain. Lionfish hunting is in the Grand Cayman Islands. Beautiful spot. Actually thinking about maybe popping off to the Grand Caymans for my big birthday in January, which the big 5-0 is coming. Can you believe it? Wow. 50, that was crazy. And Accrington is represented, of course, by Aki Chap. As always, nice to see you, Mr. Aki Chap. So let's hop right into the news, see what's going on. And there you go. Oh, yeah, if you haven't been to the website for a while, financialthing.com. I've updated this track of funds article to show some of the newer statistics. Some nifty little charts on there. It's right there on the front page. You can see some interesting percentages on mutual funds, unit trusts, and some charts on the index trackers. Why I like them so much. So yeah, go visit the website, financialthing.com, if you haven't been there for a while. Even if you have, go back. Take a look. Let's have a look at Loanpad. They sent out a update this week email saying their interests are going up. So that's beginning today on December 1st, that now the classic account has gone up to 3.6% and the premium account to 4.8%. And then this was interesting because they're going to get bumped up a little bit more in January on the first 0.1% on both of those accounts. And then in February, we see the classic go up to 3.8% and the premium account going up to 5%. So this is the one I think most people are probably going to be interested in, getting to that 5% rate on the Assetz account. But if you are just using it as a temporary, very quick place to store your money, you can use the classic account, currently at 3.6, but going up to 3.8%. So we are seeing a bump. And we saw the Federal Reserve in the U.S. making statements that they were probably going to slow their interest rate increases. But it is still nice to see these interest rates going up. I haven't logged in to Loanpad in a little bit to look at the data stream in this, so I was just going to take a look, see how things are going with the loan amounts, as I like to do every once in a while. Let's just log in. Processing, it says. There we go. Let's take a look. Total loan value now £146 million, so almost at the £150 million mark, which is pretty good. We got total security value of £185 million. Average loan to value still 40%, and the live loan number amount 174. I think that's kind of been hovering around where it's been for a while. So slow and steady wins the race. And of course, we've got these estimated times to sell, estimated times to invest less than 1 day, still 9 lending partners, and no trouble with the ICF at the moment, the interest coverage fund, which is similar to what we saw as the provision funds and other peer-to-peer lending companies. So generally, I think the numbers look pretty good. And I always really just keep an eye on this LTV, loan to value, and also these estimated times to sell and to invest. Liquidity is everything when it comes to investments. I think, if you need to exit for some reason, you can at the moment, not guaranteed, of course. And also, if you're new to this, you're new to peer-to-peer lending, none of this is FSCS protected, none of these investments. So, invest at your own risk. Look at this warning right here at the top. Don't invest unless you're prepared to lose money. This is a high-risk investment. You may not be able to access your money easily and unlikely to be protected if something goes wrong. So this is a disclaimer that every peer-to-peer company has to display per FCA rules, but it is an important thing to remember that nothing comes free in this life. Certainly risk involved in every type of investment. Loanpad is no different, but right now the numbers are looking good. Europe is going to be expecting an influx of peer-to-peer and crowdfunding firms. So we've got newly licensed firms, 6 crowdfunding platforms that are licensed, and a number of applications that are still pending. One of those that became a European Union license holder is Crowdcube, which of course is based in the UK. And they have a Spanish subsidiary called Crowdcube Europe. They're trying to expand into Europe. And they have already gone into the France, the Netherlands, Belgium, and Scandinavia, and funded more than 20 deals under their new provisions. And we got some other companies like Dutch platform ETHEX, which funds clear energy projects in Africa. So if you're based in the EU and you want to invest in some of these other companies, these alternative finance companies, they are starting to appear more now with new licenses being issued. Still, the statement here, there is a clear interest from European banks to seek deeper engagement with peer-to-peer lending and crowdfunding platforms. At the same time, some bankers are looking to this new market as a way to close the gap between early-stage finance and pre-IPO funding. So, CrowdQ is obviously a little bit different from traditional peer-to-peer lending because that's seeding money for businesses and for usually startup businesses, which I personally think is quite risky. But, any expansion, I think, within the peer-to-peer alternative finance realm is good for the industry as a whole, as long as these companies do the right thing. Crowd Property agrees loan via BrickFlow's new DIP broker product. This is very interesting. I'd never even heard of this, but there's a website out there called BrickFlow. And it's sort of a place where if you're a developer or a loan broker, you can come in here, put in all your information, and then compare loans from different lenders. And I suppose Crowd Property is one of the companies now that is listed on this platform, and it says they were able to get their loan in principle, so not actually fully funded, but in principle in just 2 hours. I would say maybe this is more considered a comparison aggregator website, but it's cool that Crowd Property is working with a new upstart website like this to expand their reach to borrowers, which is good for you as a peer-to-peer lender. Let's see if there's anything else in that story. That's about it. So I thought that was very interesting. Okay, we've got to talk about, should we do let's do the Assetz Capital. So obviously if you're an Assetz Capital investor, which I know some of you are, you lend money on Assetz Capital. You saw this email on the 28th of November. I'm sure you had some concerns, but it says over the last year, we've finally seen substantial rises in bank interest rates after well over 10 years of them languishing at near 0% levels. This has led to the access accounts becoming less competitive than they were versus rates offered for some bank savings products. We recently raised the rates on the access accounts. We saw healthy inflows of money for a period. However, after continued interest rate rises, the access accounts are now not attracting further new capital on a net weekly basis. We instead are seeing modest net outflows. If this was allowed to continue, then existing loans within the accounts that had future funding commitments, such as development loans with monthly drawdown requirements, may not be in a position to be funded. These accounts have to be able to service future funding requirements of existing development loans, as a development can lose substantial value if funding ceases mid-development. This is something we always seek to avoid as investors as well as borrowers. We would often see material losses as a result. In order to resolve this situation and avoid it, we've taken the difficult decision to start carefully managing withdrawals from the access accounts to prioritize all existing development loans being fully funded to completion. We have now entered non-normal market conditions. We saw this before happen, non-normal market conditions during the pandemic when things kind of just ground to a halt. So this is happening again, but in a different context. These changes to withdrawals are envisioned under and described in our terms and conditions. As of the 28th of November, 2022, withdrawal requests from access accounts will need to be matched to new investment coming into the account. This means that if, for example, a new investor wished to invest £1,000 into the access account, they would replace the next queue's investor wishing to withdraw £1,000. So basically, it's just another queuing system. If you want to get 100 out, somebody's going to have to put 100 in, which is, basic liquidity principles that operates on, basic secondary markets within peer-to-peer lending. And this is why these companies always say access to your money is never guaranteed, because there has to be money to pay you out. So if money is set aside for a development loan, and I'm presuming all this to be true, what's being written here, but if a development loan is halfway through and say it's being financed in tranches, Assetz Capital obviously has to have that money available to be able to give that developer the financing that they signed up for. If people start withdrawing money at too fast of a pace, then that money is not available, liquidity becomes an issue, and that could break Assetz Capital's loan business model. Quite frustrating as a lender, because obviously you see access account, you want to be able to access your money, but also understandable from a perspective of wanting to make sure that Assetz continues to operate as a business, as a company, because again, we've seen it before. Last thing we want is for Assetz Capital to run into trouble because they don't have money to lend out, and God knows what happens at that point. So it does make sense, and I definitely understand both perspectives of the frustration side of being placed in a queue to get your money out, but I also understand the perspective the Assetz Capital has been placed in. Now, the question becomes well, why is there a net outflow of money from Assetz Capital? So let's read on a little bit further. For example, a quick access account withdrawal request would be immediately added to the back of the queue, and a 90-day access account would be added to the back of the queue 90 days after the withdrawal process. So obviously, these rules are going to change depending on what account you're in. If you're in the standard access, it's different rules than it is at the 30-day or the 90-day access. So a whole lot of moving of queues going on here. No new loans will be funded by the access accounts while we're in these non-normal market conditions, right? In order to speed up the withdrawal process. And this is another important point here. This match withdrawal and investment process will continue until such time as all of the loans that access account investors hold within those accounts and that have future funding requirements are fully funded. So they want to make sure that all of the loans that have been taken out by borrowers have money to be fully completed, because you don't want these loans running into problems. We've already had enough of that going on in Assetz Capital, and we're going to look at that in a minute. After that time, withdrawals will move to being funded by both new investments and also ongoing loan redemptions and repayments. We expect that to happen in around 12 months' time, unless circumstances change. Well, one does have to ask, is the Assetz Capital interest enough to make it viable as a continuing business model? Are these rates going to increase? There's always the argument that at these rates, 4.1%, 4.5%, 3.9%, maybe for the risk that you're taking, these interest rates are not attractive, which is why Assetz Capital is seeing this net outflow. There should also be some kind of asterisk here with these well, I guess there is at the top. So these interest rates are probably not attractive enough, and this is causing a problem for Assetz Capital. I'm going to log into my account because I want to show you something that I think is definitely concerning. And I don't want to make this video to cause panic. I have not withdrawn my money out of Assetz Capital for a while. I've always kind of left it just bubbling along, taking out interest payments as I go, reinvesting capital. Hang on one second. Let me just take my phone off Do Not Disturb so I can log in here. But yeah, I've not been really reinvesting anything because I did have some concerns that in my manual lending account there was a lot of loans that were having difficulties. So I kind of just withdrew interest. I withdrew a little bit of capital during the COVID situation after that was released. And I've just been really keeping a watchful eye on what's going on within Assetz and what's going on with the loans. So let me show you here. This is the loan holdings. I think maybe some of this is going to be cut off. Let me see if I can zoom out. Hang on one second. There we go. Okay. So now you can see it a little bit better. if you look at the 304 loans here, and this is in the 90-day access account. This is where I ended up moving money to. I stopped doing the 30-day because the interest rates were just too low, and I figured, you know what, if I think Assetz Capital is okay, I'm better off just taking the extra interest, the 0.6% being in the 90-day access. Obviously, you've got to do what's right for you. Some of these annual rates are decently high. We've got some 12% loan, a 9% loan, and some of the spreads too are pretty good for Assetz. We've got 3.9% spread to the lender and borrower rate on that loan. Say this 8.5% to 10.4%, so a couple of percent spread, not a big one. But they have enough spreads to where I think Assetz is able to make money. What is concerning here, in my view, was how many loans were in traded suspending. And I haven't been through all of the loans, but out of the 304, I think I counted about 50. So if you go through and look at all the red trading suspended loans that you see, it starts to get worse towards the bottom. Is 50 out of 300 and something loans, we're talking about, what is that, 20, no, not quite 20%, 15, 16% of this loan book being trading suspended. All right, look at all these down here at the bottom. So question, are the loans good? And is the interest that you're getting paid enough to be needing, wanting to risk these loans running into issues? Then the other question is, well, is Assetz Capital making enough money so where they can really increase those interest rates to compensate people for the risks that they're taking? So if they, if there's spreads of 2, 3, 4%, in some cases 3.5% on these rates. Let's look at this 9% loan. So we got a 2.15, but also Assetz Capital makes money in other ways. They make money. Let's look here. They make money. Let's see if it says it on it. Oh, another thing too, by the way, the provision funds on these accounts are just really, really low. We've got a £150,000 provision fund on a £51 million investment. So there really isn't any much cushion if these loans do go into difficulties. Right. So here's some of the fees that Assetz Capital charges to borrowers. We've got arrangement fee, net of broker fees, 7.5%. So they're charging a 7.5% fee to arrange the loan. Then we got these monitoring fees. They're 5.5%, right? And these are maximum charges, so these are going to vary. But anywhere from 0, so you got up to 5.5% monitoring fee, and then an exit fee of 2%. So if Assetz is charging these higher fees, they probably have some room and some cushioning to be able to, offer more attractive interest rates than they're offering on these access accounts, which would prevent people from leaving the investments, right? If you're not getting compensated enough, you're going to leave. Right, so the 30-day access rate is paying, what is it, 4.1, I think, 4.1. Let's see. Sometimes it's not easy to find. Here we go, yeah, 4.1% target gross. And I just don't think through Assetz's business model, people are starting to understand, and this is going to happen with the lower interest rate peer-to-peer lending companies, that if they can go get a 1-year bond of 4.3%, doing a 30-day access maybe with no guarantee because your capital is at risk, 4.1% just doesn't make any sense. Especially when you see all of those loans with those trading suspended red marks next to them. Now, if you compare that, say, to a company like Loanpad that does not have as many issues with their loans, if any. I mean, there may be a couple of small ones, but you go into their loans, 174 loans, you don't see all these issues. So this is definitely an area of concern, because you're not being paid a lot more from Assetz Capital to take this extra risk with SMEs, small and medium enterprise lending. So that's my view on things. Do I think it's going to get better? I think it really depends on sentiments, on what people feel about Assetz Capital. They think it's a solid company. If they're happy with the amount that they're getting paid, they'll stay put. We've seen companies get run on, peer-to-peer lending companies, cryptocurrency, even banks. There's been runs on banks before where people just decide, they get panicky, and they think, it's not worth the risk anymore. So that freeze has obviously been put into effect for a reason. I'm wondering what that net outflow is. I don't know what that amount is, whether it's a very high amount or whether it's slightly under what they're expecting, and that's why they put the freeze on it. We don't know what those numbers are at the moment. But I think Assetz Capital at the end of the day is just going to have to offer more interest to people to match the amount of risk that they're taking. So that's my 2 cents on it. I'm not panicking at the moment. We've seen it happen before. This is not unusual. It's definitely not what we like to see, but it's not unusual. It's a company protecting their business interests to hopefully do the right thing by you as an investor. So we'll see what happens in the future. Maybe I'll reach out to Stuart Law, see if we can get him to come on the stream, talk about what's going on, give us his insight. But certainly not the kind of thing you want to see pop up in your inbox. But what do they say? Hope for the best, expect the worst. Lend Invest, this is their October 2023-22 platform update. Well, remember, Lend Invest not strictly a peer-to-peer lending platform, but we do cover them because it falls in the alternative finance sector, and I think they're offering a good product. They posted 4 new loans this month. Average loan to value is 67%, while you're getting 5.5% in return. Now think about this. If you compare this to Loanpad, and Lendinvest is a much bigger company. By the way, I've been to visit them both. Loanpad is not Lendinvest. Loanpad is a smaller company, a smaller operation, smaller operating expenses. One may argue Loanpad has a more sensible business model than Lendinvest because of the way they operate, the way they have everything structured. But if you look at what you're getting here on an average loan to value of 67% for a average of 5.5% per annum, that's a lot higher than a company like Loanpad for not much more of an increase in returns, especially come January when Loanpad will offer 5%. So now you're only 0.5% higher with a much higher loan to value. Granted, for a bigger company, more operating experience, but you do want to think about things like that when you're investing, because I think it makes sense. Yeah, 4 new loans written, not a ton that in October, but we look at their statistics as far as in schedule, 72%, 5% in arrears, 16% out of term, 7% are in enforcement stages. So you definitely like to see those numbers a little bit lower. But if you're a Lendinvest investor, keep an eye on these monthly reports. It does tell you a lot about what's going on. And I think the best thing we can do as investors is definitely stay informed, stay abreast of things, and just really keep an eye on how these companies are operating. Because we've been burned enough, right? Let's just face it. We don't want to see another one of these companies have issues. The FCA plans to make financial advice more accessible. The FCA has released its new proposals on how to make financial advice more accessible to retail investors. The regulator plans to create a separate, simplified financial advice regime, which will make it cheaper and easier for customers to get advice on mainstream investing within stocks and shares. My question is, why just go to YouTube? There's plenty of influencers out there that have really good stock and share investments. I say that tongue in cheek because there's a lot of influencers who are, giving investment advice where they probably shouldn't be. This follows a recent FCA survey which found that 4.2 million Brits have more than 10 grand in cash but are open to investing at least some of it. The FCA has noted that excessive cash holdings can be eroded by inflation, whereas investing could yield better results for informed investors. Yes, but there is also a flip of that. If you're holding cash during a really tough time in the stock market, you are going to be better off in cash than you are investing. So these investors really need to know what they're getting themselves into. I'm wondering what this financial advice regime is and how did that come to be? Is that something the financial companies were pushing the FCA to put out, or is this something completely independent? It's a good question. What do you think? The FCA's current proposals include streamlining the customer fact find so that it's easier to find and understand financial advice. The regulator also wishes to limit the range of investments within the new regime so the advice is easier to deliver and understand. So now the FCA is deciding for you what you should be exposed to. Sounds like a form of control to me. The FCA has also suggested making the qualification requirements for the new regime more proportionate, so delivering the simplified advice is less costly for firms, following and allowing advice fees to be paid in installments so customers aren't burdened by large upfront bills. This feels to me like it was the financial companies that went to the FCA and were pushing for this regime to be put forward. I would like to know, how this came to be. Was it the FCA who just came up with this out of their own magnificent brains? I don't think so. Okay, so we have seen this big mess of what's going on in the cryptocurrency world at the moment, and I think we can learn a lot. Just going to plug in my headphones. There was an interesting video that was put up on the New York Times website recently. I think it was today. And I find it a little bit comical. Obviously, if you've been hiding anywhere out in the wide open, you know what's going on with FTX, the massive cryptocurrency platform that all of a sudden just imploded with billions of dollars of consumers' money. Let's see here. This guy again, he's going to make Bernie Madoff look like a really, really small fish at the end of the day. So he put out a video, and I'm going to just play this because he did an interview with the New York Times, which I think is very brave. I figured he'd have probably been in hiding by now and just had disappeared. And let me play this to you. It's very interesting. The collapse of FTX. This is, again, on the New York Times website, so very credible. Let me turn on the audio so you can hear what this guy has to say. I like to say hiding. I don't know if he's hiding. He's in the Bahamas right now, sitting on all of his money. Hang on. Let's see if I can turn this on. Okay, hopefully that didn't mess anything up. Yeah, I bet there's a lot you wish you had done differently. I personally, I just don't believe a word coming out of this guy's mouth. It was very interesting at the beginning of the interview. You can see he's clearly nervous. If you take a look down here at his arm, he's very nervously shaking. He's under a lot of scrutiny at the moment, mainly due to funds being removed from FTX right before the collapse and into his Alameda Research, other company. And he's still saying that he's an innocent guy. So there's a couple of interesting clips here. He's saying that he made a mistake. He didn't know that there was a big issue. Here's another one right here. We met. This is his response. This is a company that was valued at $1.32 billion, and you got this guy who is a very smart guy. Obviously, he's very intelligent, but he's running a company of $32 billion valuation, and apparently there was reports coming out saying that their accounting was done on an Excel spreadsheet, and a lot of these people were kids. They didn't know what they were doing. But the reason why I'm talking about this is we can learn a lot about investing from this perspective. And cryptocurrency has taken a really tough beating over the last couple of months. We've seen other companies go bankrupt, go into bankruptcy, several because of this FTX situation, including a company called BlockFi, which announced bankruptcy. They were heavily tied to FTX. Gemini possible. We've seen Celsius, and these are big companies with a lot of money, and they're unregulated. Obviously, cryptocurrency needs to have regulation. Now, is regulation the be-all and end-all? No, because we've seen regulated companies within the peer-to-peer lending space go into bankruptcy and go into administration. So, does regulation solve any of these problems? No. At the end of the day, what the problem is, we got guys like this. Call him a criminal if you want. I don't know if he's a criminal or not. I don't know what his true intentions were. But we have people like this ruining companies, ruining sectors. We've seen it within peer-to-peer lending. We've had, obviously, the Lendy debacle, the collateral debacle. We've seen it within big, huge companies like Enron, Arthur Anderson committing, accounting frauds to pump up their stock prices. It happens in every type of sector. And I think at the end of the day, there really isn't any safety mechanism that is going to 100% protect you as an investor, aside of being in a protected bank account, in a savings account where you're going to earn whatever the bank wants to pay you. So if you want to take risk and try to earn yield, you're going to be faced sometimes with idiots who run their company into the ground, be it via fraud or just incompetence, is going to happen. And it's unfortunate. Now, there are some peer-to-peer lending companies out there that are not regulated. So if you are looking at companies, and I think the FCA regulation now within peer-to-peer has made things better, a lot better for investors. I feel a lot better about investing now in peer-to-peer loans because I feel like the regulation has tightened up a lot and these companies are under scrutiny. But you do need to pay attention to companies, I believe, such as Somo, who are not regulated. Even though on their website it says that Social Money Limited is regulated, if you delve a little bit deeper and you look into their Q&As, hold on. Where is it? It says on Somo's website that they are not regulated. Somo allows investors to select which borrowers to fund and which securities to take. I don't know if Somo is a good or bad company, by the way. I'm not saying anything bad about them. I'm just saying as far as regulation goes, it's something to pay attention to. The underlying loans within Somo are secured over UK property by a short-term unregulated mortgage or legal charge, but also Somo has it listed on their website, and I had it pulled up before. Let me see if I can Google to show you, but it does show that Somo is not regulated. So pay attention to things like that, because I think at the very least, it is one way you can protect yourself. Even albeit, if a company does go down the proverbial poopers, that you're not necessarily going to get your money back. But it is important to pay attention to. If you look down at Somo, here it is down here. The Somo business is unregulated for both borrowers and investors. And this is important to pay attention to. And I do, I've said things about the FCA in the past, whereas I don't really necessarily think that the FCA is helping investors, but I do think they have made some improvements to the way regulation is being placed on these peer-to-peer companies and the way they're scrutinized. And I wonder sometimes if these companies that are not regulated do it because it's too difficult now for them to become regulated in a fashion which would bring them credibility. Here's another company that I found that is not regulated called Huddle Capital. So again, just shows nothing about the company being regulated. So just pay attention to that. We can learn some things from what's going on in cryptocurrency. But at the end of the day, if people like Liam from Lendy, who they were regulated, if people like that do exist, and the Collateral Brothers are out to defraud people, regulation isn't not going to necessarily prevent that. So these types of frauds and company implosions are happening over different industries and sectors, and it's kind of become commonplace. But one thing that I think is important about cryptocurrency is the fundamentals of the technology and what cryptocurrency was designed to do has not changed. I mean, people have caused cryptocurrency to have massive problems at the moment. People like Sam Bankman-Fried and Alex Mashinsky from Celsius, they've caused it. It's not the cryptocurrency that caused it. It's the people. And it's always the people that cause these implosions. But there's an interesting news article here. This is BlackRock thinks as crypto technology still relevant despite FTX. This is the chief executive Larry Fink of BlackRock says that there appear to have been misbehaviors. I find that very soft. Wording. There appears to have been misbehaviors by the now bankrupt FTX exchange. The technology behind crypto is relevant for the future. All right. Despite all the problems around FTX, Fink says he considers the technology behind crypto will be very important, he added. I believe the next generation for markets and next generation for securities will be tokenization of securities. So, Bitcoin, I've always been a supporter of it. I invest in it myself. I'm not saying it should be right for you. That's really dependent on your risk tolerance. But every time I have seen a sector get decimated, in most cases, has been the time when most people are worried and everything is burning down to the ground. That's the time when I have seen opportunities. So we need to pay attention, though, to who's running these companies, what we know about them, and I think important, try to do some research. Again, whether you're looking at peer-to-peer lending or if you're looking at a private bond, I've gotten emails about that. People who say, do I think this mini bond is a good thing to invest in? I say, look, do your research in the people running these companies, because at the end of the day, no matter how good the investment is, those people running the companies can bring down that company with one bad move. Yeah, we saw that with FTX, a several billion-dollar company imploding in one business day because of certain people's actions within those companies. So let's pay attention to the people running the companies and make sure that they are on the up and up and they're qualified to be doing what they're doing. That's my 2 cents, my 3 cents, my 3 pennies. Quick look at the Trading 212 portfolio, which has taken a good kick in the Bolocks. Here we go. We are down to 18,640 pounds, so we've dropped about $1,000. This portfolio is edging up towards 20,000 recently within the last 3 weeks, and now we've come right back down again. And I think this is what we're going to see from the stock market for the next few months. We're just going to see this up and down, sideways, back and forth action with no real momentum, no way forward. Our precious Calera shares that I put 3,000 pounds into is back down to 131, even though it's up 12% today, which is nice. But we've had this downfall from 148 down to all the way down here. Look at this volatility. If you want to make your stomach turn, invest in a small cap, high risk stock like this. 106. So we lost 40%. And then pump right back up 12% to 131. But Zim Shipping has been, they've announced a big dividend payment that if you own Zim Shipping stock on November the 28th, before that, so the 27th, you would receive a nice dividend. So if you own 100 shares of Zim, you get a payout of $295. So what is that? 295, about 241 pounds. So big time dividends, but this will make the stock price fall once the dividend gets announced and paid out. The stock price tends to dump. That's just the way it is with dividend stocks. So we've seen it go down now in the red to 20%, but we're going to get paid a decent size dividend. So we've got, what, 73? Oops, hold on one second. 73 of those shares. So, by the way, if you ever wanted to look at dividend stocks, I don't know if it has, I think it might have UK in here too, but you can, it's dividendmax.com. I really like this website. You put in 73, so we're going to get a $215 dividend payment on December the 7th. So that's pretty nice. But everything else looking pretty shaky in the portfolio. Not too bad, but things in the red. We still got Flex, natural gas up 50%, but the rest of them dipping into the red. This DNA, Ginkgo Bioworks holding down 23%. Calera's up 16%. Vermilion hovering 5% in the red. Walt Disney 5% in the red. Norwegian Cruise Lines 2.3% in the red. And so really mixed bag. Even Deutsche Bank 3% in the red. So I think we're just going to have a struggle in the markets for now. We'll see what happens. Even though the Fed did announce these interest rates slowing, which pumped up the FTSE 100 and the NASDAQ and the Dow temporarily, but we'll see if that continues to be a market mover. I think we've probably been talking for long enough. 54 minutes. Okay. Well, see if you have any interesting comments. It's looking a bit moist in Accrington. That's funny. Most property peer-to-peer lending sites have an inflow and redemption issues. At least crowd property has taken taken direct action. Yeah, I mean, this is kind of the age-old problem of demand and supply. Do you have enough money coming in to fund loans? Do you have enough loans to put investors' money to work? Always the age-old balancing act. Yeah, Bankman. Yeah, can you imagine? Oh, sorry about the sound. Did I do something wrong? Can you hear me? Can you hear me now? Oh, hang on. Maybe the headphones. Who knows? Anyway. 1 second. Well, my mic is working anyway. Apologies for that. So you didn't hear anything probably of what I said. I don't know what you missed, but maybe I'll make another video going through that again. Oh, you couldn't hear the video. Okay. Hold on 1 second. Oh, I see. I don't know why it's not playing. Huh. It should play. Come on, New York Times. Well, you can go to, if you go to newyorktimes.com, you'll be able to watch the video yourself. Basically, the guy's saying I messed up. And he's not really giving any good reasons as to how he messed up or why he messed up. He's just saying, I messed up. So, it is what it is. But yeah, go to the just Google FTX and the video is all over the internet right now. And it's quite fascinating, I think. Why are you not playing? That's frustrating. I'll get that sorted. I think because I switched the sound during the stream to listen in the headphones. I think it might have done something to the output of the audio. So apologies about that. You know, I'm pretty good at these tech issues. I have at least one snafu every month. Hang on. Yeah, I don't know why it's not playing. Something to do with my software. Apologies about that. Yeah, it's on YouTube as well. The video's everywhere. It's pretty interesting. Yeah, I'll put the link on. I like the New York Times video because it has some. It's kind of like snippets of the video versus you having to watch the whole interview. If you want to watch it all, I think it is an interesting interview. But if you want the snippet, I put it in the chat right there, so you can go check it out. So, just a reminder that there will be no stream on the 22nd and the 29th because I will be heading across to the pond to London and then taking a couple of days, holidays, and I'll be back New Year's Eve. So probably streaming on I may do an impromptu New Year's Day stream. I don't know, but most likely back on the 6th of January. So if you don't hear anything to do with streams and stuff like that, you'll know why on the holidays. Trying to avoid the rail strikes and the Euro star strikes and all that good stuff. But I think we're going to end it today and have a great weekend, everybody. Enjoy your weekend. I know it's very chilly and moist apparently over there, so I'm not even going to tell you the weather over here because I don't want to piss you off. But wrap up, put a hat on, enjoy yourselves, have a great weekend. Thank you again for joining in. Still working on the guests. We do have, I believe, a guest in January coming up. I have to look in my notes. I think it's folk to folk, as I remember. So hopefully in January, but working on some more. Not always easy getting guests. Not everybody wants to put themselves out there for you guys, but working on it. So if there's anybody that you want to see, put it in the comments and I will try my best to get them on here. So anyways, I'll be back next Thursday on the 8th of December, if not before. And I will see you guys soon. Much love to everybody. Thanks for coming.